What's going on, everybody, and welcome back to Exploring Investments with Justin. And in today's video, I'm going to be talking about dollar cost averaging your positions down. And me personally, I do this in all of my investments because I do think this is a very smart investment strategy, especially if you're a long-term investor. And in this video, I'm going to be talking about what dollar cost averaging is, what the benefits and risks of this investment strategy are, and an example where I actually lowered my cost basis from $28 to $16 a share. And then I'll also be sharing a spreadsheet that I created. So be sure to stick around to the end of the video because this spreadsheet is going to be really helpful for determining whether now's a good time to maybe dollar cost average down or maybe wait until a bigger dip comes. And be sure to let me know in the comment section down below if this is something that you guys want me to share with you, because I can easily create a link and you guys can have access to it. So with that being said, let's jump right into today's video. So when it comes to dollar cost averaging a position, there's really two ways that you can do this. You can dollar cost average up, and this is really something that you see with your 401k, where every week they take out, say, $100 and they invest that into some ETF that's through your brokerage. And they do this on a weekly basis, so your dollar cost averaging really upwards instead of down. Now, me personally, I like to do the other dollar cost average, which is to go down because I want to lower my cost basis on my positions. So that's really what I'll be focusing on for the purpose of this video. And as a long-term investor, I feel like this is a crucial investment strategy that you have to know, because when you have a long-term outlook on a company, you don't want to sell on the dips. You want to buy more and dollar cost average down whenever a company's stock price falls. So in short, dollar cost averaging down a position is when you really have an idea of what you want your total investment in a company to be. So like, say you want to buy Carnival Cruise Line and you want your total investment to be $1,000 in this company, you'll decide before you invest how many investments you want to split that $1,000 into. So maybe it's 3 investments, maybe it's 5 investments. It's really up to you, but you split it into multiple investments. So essentially what you're doing is you're lowering your cost basis every time you invest and add more to that position. So that's essentially what dollar cost averaging down is. And now what we're going to talk about are some of the benefits and risks of this investment strategy. And I'll be talking about personal examples that I've gone through in the stock market just to help you guys learn from my mistakes. And I really want to note that as a long-term investor, it shouldn't really matter to you whether the stock is up, say 5% or it's down 10%, because short-term moves are really irrelevant. And if anything, short-term moves on the downside create buying opportunities. So for this example of looking at the benefits, we're going to look at Tesla. So this was a stock I started buying when it was about $225, and I've held my shares all the way up to $1,500. Now, it could go to $2,000 next week, and I still wouldn't sell because I plan on holding this stock over the next 5 to 10 years. And if it were to fall down to $500, I still wouldn't sell, and I would actually buy a lot more shares. So the biggest benefit, in my opinion, is the fact that volatility doesn't really affect me, because when the stock is up, I just hold on to it, and when it drops, I buy more. And when you do this, not only are you building a bigger position a little at a time, but you're also lowering your cost basis at the same time, which has the potential to net you bigger profits than if you had just thrown your full investment into the stock at one time. So what I'm actually going to do here is I'm going to switch to my Carnival Cruise Line position, and we're going to look at this and what I did as the stock market was crashing a couple months ago, and we're going to analyze what I did here in terms of dollar cost averaging down my position. So as you can see here, during the stock market crash, I was buying a lot of Carnival Cruise Line stock because it had been crashing pretty hard, and the first time I bought shares was actually at around $28 a share. Now obviously, as we all know, the stock ended up going significantly lower from there, and it actually bottomed out at around $8 a share. So on the way down, I just kept buying, and as you can see, I bought when it was at $22, $16, $10, and even near the low at $8. So I eventually reduced my cost basis by almost 50%, going from $28 to about $16 a share. And the reason why dollar cost averaging down can be a huge benefit is because this ultimately helped me break even when I went to sell my shares at $16 a few weeks ago. If I had just put my full investment in at $27 a share, I would be down somewhere around $800 right now. But luckily, I dollar cost averaged down, and I ended up just breaking even and getting out of the position. position. Now, the reason I chose Carnival Cruise Line for this example is because I also made a critical mistake when I was dollar cost averaging down with this investment. So the mistake that I made is that I never made a decision on what my full investment size was for this position, and I ended up putting way more money than I should have into this company. And at the time, I was doing this with the goal of lowering my cost basis as much as possible without paying attention to the size of my investment relative to my portfolio size. And that's why I said at the beginning of the video, you need to make sure that before you go into any investment, you know what your max position is in a company and you stick to it as you dollar cost average down. So my position in CCL ended up being about $2,000 when realistically it should have been more like $750 to $1,000. And this would have come out to about 5% of my portfolio. So again, make sure that you have a plan and that you stick to it before starting any position. So real quickly, I wanted to share this spreadsheet I made with you guys, and I really relied on this heavy during the stock market crash that we saw back in March. So as you can see, this spreadsheet tells me everything that I need to know before I start my position in a company. And basically what I can do here is I can put in what stock I want to track, and you do this by going to the data tab and then putting in the stocks. And really all I have to do with this is put in the number of shares that I want. But first you got to make sure it's updated and refreshed, and you can see that it's automatically updated all the stock prices. So all I got to do is put in the shares that I want to buy. So maybe I want to buy 5 more Skyworks Solution shares. Automatically you can see that it tells me what the total cost of that investment is going to be, and then what my new average cost is at this current stock price level. And then you can see that I'm actually increasing my average cost basis by 27%, or in terms of dollar value, it would be $23 that I would be increasing it by. And then you can really evaluate from there, okay, is that too high of an average cost, or would I like it to be lower? And then you can say, all right, well, maybe I want to add 3 shares, or maybe I want to stay at about $100 a share. So maybe I add 2 shares. And so this is definitely something that I really like to look at whenever I'm looking to add more to a position. And as you can see here, I've got my max investment. Like I said, I learned from my lesson, and I now know what my max investment is before I start a position and what percent of my portfolio it ends up being. And then real quick at the bottom here, I've got what my buy points were, and to be honest, I really haven't updated this in a while because like I said, I used it back in March pretty heavily, and then once the stock market started going up a lot, I really stopped looking at it and using it because I haven't really been buying or adding to many of my positions. So let's put in $140, it automatically switches to buy, and this will happen when I do my refresh and I update the stock prices. So let me know in the comment section if this is a spreadsheet that you guys want me to share with you, and I'll be more than happy to do that, and I could even add some instructions here on the bottom. But I really do feel that this is a spreadsheet that could be very beneficial to most long-term investors. And with that being said, guys, I just want to say thank you for watching. Be sure to hit that like and subscribe button because I will be putting out more content, and I will catch you guys on the next one.